Ever walk into a room and feel like everyone's speaking a language you don't understand?
Yeah.
That's what it's starting to feel like trying to keep up with climate risk, especially prepping for those investor meetings.
Yeah.
It's like everyone had a secret decoder ring, and I was scrambling to catch up.
Right.
Well, don't worry. We're diving deep into this world of climate-related financial disclosures. No jargon allowed.
Exactly. We're going to make you fluent.
So today we're breaking down the recommendations from the task force on climate-related financial disclosures, the TCFD.
They're basically the people setting the standards for how companies should be talking about climate change and, more importantly, the money involved.
So no more vague, feel-good sustainability reports.
No, we're talking about cold, hard financial impacts. Investors are realizing climate change isn't just an environmental issue anymore. It's a potential financial earthquake. Remember the 2008 crash?
Ooh, yeah.
Lack of transparency was a huge part of what fueled that.
Right, like nobody actually understood what those mortgage-backed securities were.
Exactly.
And then, bam.
Exactly. Investors are determined to avoid a repeat performance with climate change. They want to know which companies are truly prepared for a future where things like extreme weather events aren't just headlines, but bottom line hits.
Okay, so it's not enough to just slap a green label on something anymore.
Not even close. The report digs into some really interesting categories of risk, starting with transition risks. These are all about how the world shifting to a low-carbon economy can impact a business. And like you said, it can be good or bad depending on how a company is positioned.
Right, so like, are they ahead of the curve or are they dinosaurs about to go extinct?
Basically.
So walk me through this. What are some examples of these transition risks?
Well, you've got government policies, for one. We're talking carbon taxes, stricter emissions standards, things like that. Then there's the technology evolution. Are companies investing in renewables, or are they clinging to outdated, polluting methods?
Adapt or die, right?
It's like natural selection, but for businesses. And don't forget about market dynamics. Consumer preferences are changing rapidly.
Oh, right. If a company's still pushing gas guzzlers in a world obsessed with electric vehicles,
You got it. Their bottom line's in trouble.
and then there's that whole reputational piece.
Huge. I mean, look at how powerful those viral social media campaigns can be. They can tank a brand overnight if they're seen as climate villains.
Oh, yeah, for sure.
And it's not just activists anymore. Investors are factoring in these reputational hits, too. They know it can translate to real financial damage.
Okay, so the TCFD wants companies to move beyond simply listing these risks. They want to see the actual financial impact, right?
Exactly. Paint me a picture. How do these risks actually play out in the real world?
Let's take a company like, say, a big agricultural company.
Mhm.
Climate change is making extreme heat waves and droughts more frequent,
Right.
and those can be devastating for crop yields.
Absolutely. We're talking about massive financial losses, potential supply chain disruptions.
And I'd imagine their insurance premiums would go through the roof as these events become more common.
Exactly. But on the flip side, let's say that same company has invested in drought-resistant crops or more efficient irrigation systems. They might not just weather the storm, they might actually come out ahead. That's the kind of analysis investors are looking for.
So it's kind of like a high-stakes game of chess, trying to anticipate those future moves and adapt your strategy.
Exactly. And that's where the second category of risk comes in physical risks.
Okay, this sounds a little more, well, physical.
Think of it as the more immediate, in-your-face impacts of climate change.
So like the hurricanes, floods, and wildfires we keep seeing more and more of these days.
Exactly. Those are what we call the acute shocks. The TCFD wants companies to assess how vulnerable their physical assets and operations are to these extreme weather events.
Okay, that makes sense.
Right.
A factory in a flood zone, for example, probably doesn't look like such a safe investment anymore.
You got it.
But then there are those slower burn risks, the chronic ones, that don't always make for dramatic headlines, but can still pack a financial punch over time.
Absolutely. Things like sea levels creeping up, temperatures steadily rising, these can have a huge impact on certain industries. Think about a coastal property developer, for example. Gradual sea level rise might not seem like a big deal today, but over time,
It's going to erode property values, increase insurance costs, maybe even make some areas completely uninhabitable.
exactly. And suddenly that prime beachfront property isn't so prime anymore.
Okay, so we've talked about how climate change can really mess with a company. But this TCFD report isn't all doom and gloom, is it?
Definitely not.
There's a whole section on opportunities, right?
Right.
And honestly, that's what gives me hope in all of this.
It's not just about dodging bullets. The transition to a low-carbon economy is creating some massive opportunities for companies that are ready.
Okay, so color me intrigued. Give you the rundown. What are some of these big climate opportunities?
Well, resource efficiency is a big one.
Resource efficiency. Okay.
It sounds kind of basic, but companies waste a ton of money on energy and materials.
Yeah, I
Yeah.
see that.
The report actually highlights companies that are embracing things like energy efficient buildings and sustainable supply chains to slash their operating costs.
Oh, wow.
They're also using cutting edge production processes that minimize waste.
So it's like that old saying, waste not, want not, but like on a massive corporate scale.
Exactly. Then there's the energy source itself. This whole renewables revolution is a gold rush for certain companies.
Yeah, yeah.
We're talking solar, wind, geothermal. These aren't just alternatives to fossil fuels. They're creating entirely new industries.
Right, right. And it feels like it's moving so fast. I mean, I actually just got solar panels installed on my house, and it's been incredible. My energy bills have basically disappeared.
I love to hear it.
It's clear this shift to renewables isn't just about saving the planet. It's about new markets, new technologies, shaking things up.
It's a total paradigm shift.
Yeah.
And on top of all that, we can't forget about the power of consumer demand. People are way more willing now to spend a little extra for products and services that align with their values.
Yeah, totally.
So companies that can tap into that desire for sustainability, they're the ones that are going to succeed.
For sure. I know I'm definitely more likely to buy from a company that's making an effort to be eco-friendly, even if it means spending a few extra bucks.
Right. It's not just a niche market anymore. It's becoming mainstream. And finally, there's resilience. The companies that see climate change not just as a threat, but as an opportunity to innovate and adapt,
Yeah.
those are the ones that will be most successful.
It's like they say, the only constant is change, right?
Or-
The
Yeah.
companies that are agile, forward-thinking, the ones that can ride these waves of change, those are the ones investors want to get behind.
Precisely. And that brings us to the heart of the TCFD recommendations, their framework for disclosure.
Okay, so this is how they expect companies to actually report on all of this.
Right. It's what investors are looking for in these disclosures.
Got it.
The TCFD recommends companies focus on four main areas: governance, strategy, risk management, and metrics and targets. You can almost think of it like a report card for how well a company is managing these climate risks and opportunities.
Okay. Okay, so starting with governance, that sounds pretty important. Does this mean the folks in the C-suite actually need to care about climate change now?
More than caring, they need to be demonstrating real leadership on the issue.
Got it.
Investors want to see climate change embedded at the highest levels of decision-making with clear accountability from the board of directors on down.
So no more burying their heads in the sand and hoping it all goes away.
Exactly. Ignorance is not a valid business strategy anymore.
Right. Okay, what's next?
Then there's strategy. This is where companies need to show they're not just reacting to climate change as it happens, but actually incorporating it into their long-term plans.
Right.
They need to be asking themselves what the short, medium, and long-term risks and opportunities are, and how they're going to adapt their business models not just to survive, but to thrive.
So it's about anticipating those future moves like we were talking about earlier.
Exactly.
Okay, what about risk management? That seems pretty crucial.
Absolutely. Investors want to see that companies have really strong systems in place to identify, assess, and manage those climate-related risks.
Okay.
And it's more than just acknowledging that the risks exist. They need to show they've got a plan to actually mitigate them.
So like a financial fire drill, but for climate change scenarios. Yeah.
Exactly. And finally, there's metrics and targets. This is where things get real.
Okay.
Investors want to see cold, hard data. How are companies measuring their actual impact on the climate? Like how much greenhouse gas they're emitting, or how much water they're using, and what are their specific targets for reducing their impact and improving their performance?
Right, because what gets measured gets managed, or at least that's the hope.
Exactly.
But this all seems incredibly complicated.
Yeah.
How do you even begin to put a dollar figure on something as complex as climate change? I mean, where do you even begin?
That's where materiality comes in. The TCFD is really emphasizing that companies should focus on disclosing information that could have a significant financial impact on their business.
Okay.
It's about cutting through the noise and focusing on what really matters to investors.
Got it. So no greenwashing allowed. They want the real deal.
Precisely. And to really assess those potential financial impacts, especially over the long term, The TCFD recommends a tool called scenario analysis.
Scenario analysis. So we're talking about like predicting the future now.
It's not really about predicting the future as much as it is about kind of like stress testing your business,
Yeah.
seeing how it holds up against different possible futures.
Okay, I think I get it.
The TCFD actually recommends using different scenarios, like a world where we hit the Paris Agreement goal of keeping global warming below 2 degrees Celsius,
Right.
or even scenarios where, things don't go so well and we see the more severe impacts of climate change.
So it's all about being prepared for different possibilities.
Exactly. Okay, so let's say you're a big energy company, right? They would need to analyze what happens to our business under a scenario where, let's say, a major carbon tax is implemented.
Right.
Like, are our investments in renewables going to pay off? Or are we way too reliant on fossil fuels, which would suddenly become a lot more expensive?
Oh, wow.
Exactly. So you've got to think about those different possibilities. And the TCFD wants companies to be transparent about these scenarios, too.
Makes sense. So it's not just about cherry picking the rosiest outlook and hoping for the best.
Exactly. Investors want to know that companies are considering all the possibilities, even the not so pretty ones. But honestly, this is all pretty new, isn't it?
Yeah.
I mean, even the TCFD report kind of acknowledges that this is a work in progress.
Right. And I imagine getting all the data you need for this kind of analysis can be a challenge in itself.
Oh, absolutely. The data can be all over the place.
Yeah.
And figuring out those long-term impacts, that's tough.
It's not easy being a fortune teller, especially when it comes to something as complex as the climate.
Exactly. And let's be real, some companies are going to be a lot better at this than others, at least for now.
For sure. So where do we go from here? What's the takeaway for our listener who might be thinking, okay, this is all very interesting, but why should I care?
Well, this isn't just about some dry corporate sustainability report that's going to sit on a shelf gathering dust. This is about understanding the companies you're investing in, working for, or even just buying stuff from. Because as this framework becomes the norm, the companies that really get it, the ones that figure out how to navigate all of these risks and opportunities, those are the ones that are going to thrive.
So whether you're an investor trying to pick stocks or you're thinking about your career, or even if you're just someone who cares about the planet, this is becoming essential knowledge.
Exactly. It's about having the information you need to make smart decisions in a world that's being reshaped by climate change right before our eyes.
And on that note, we'll leave you with this. As these climate-related disclosures become more and more common, how do you think they're going to change whole industries?
Mm.
Could this be the thing that finally pushes companies to become truly climate resilient, to come up with innovative business models?
That's the billion-dollar question, and one we'll definitely be exploring further in future deep dives.
Thanks for joining us for this deep dive into climate-related financial disclosures. We hope you surfaced with some fresh perspective.
And maybe even a few ideas you can actually use.
Until next time.
See ya!